Hi, Sandy Albers with Insurance Agency Marketing Services. Just wanted to say thank you so much for attending this morning's webinar with One America. We just so greatly appreciate you taking time out of your schedule to do that. I head up the SPL division here at IMES, and before I turn it over to Brent DeGroot, who is a great partner not only for IMES with One America, but also his team for agents as well to help with any questions that anyone may have. So let me get through a couple screens real quick here. I wanted to let you know, when you contract with IMES, we have something called a new producer bonus. When you place $100,000 of business with us, whether that's single premium life, traditional life, annuity, long-term care, combination thereof, you can choose, we reward you for that. We say as a thank you, and you can choose a 1,500 piece postcard mailing. You can choose $750 in cash, or you can do some marketing analysis and corporate identity package through our creative team. If you'd like to skip that and in your first 6 months you think, gosh, I think I'm going to place $250,000 with IMES, you can choose a 3,000 piece mailing. You can choose my favorite, which is a $1,500 Visa gift card, or you can choose $2,000 to be deposited in your marketing reimbursement account, which I will go over with you shortly. If you'd like to hold off on that and you think you're just going to go gangbusters your first 6 months with us, which we hope you do, and place $500,000 with us, again, that is single premium life, annuity, long-term care, med sup, traditional life, combination thereof. You can choose a 5,000 piece mailing, postcard mailing, and get training assistance with one of our top producers, Matt Gill. You can choose a 4,000 piece postcard mailing and get seminar assistance with one of our top producers, Dave Pimper. You can do a billboard ad, a seminar presentation, a full website or a website overhaul, or you can choose, my favorite out of all of this is a Ritz-Carlton Travel Rewards getaway for you and a guest. If you'd like to hold off on that and go up to the $750 level, you can do a video for social media campaign. You can do a Retirement Boss Radio, which is a radio segment, and that includes a setup cost and 8 recorded shows. If you want to do $1 million in your first 6 months with us, you can do a preset annuity appointments, which are between 8 and 10 appointments. You can choose a core story brand builder and get published in major news outlets with ABC, Fox News, NBC, etc. So as you can see, we really like to build our agents, and this is again for just doing business with us. We also have something called an I'm Business Builder, and what that is when you refer an agent over to us, as a thank you, when that agent gets contracted, we send you a $50 one-time bonus. When that referred agent places their first piece of business, we send you $100 as a thank you for entrusting us with that referral. You, from that point on, get an override on that business that is placed by that agent. It doesn't come out of that agent's commission. It doesn't come out of your commission. Again, this is a thank you from IMES for entrusting us with that agent. You get 20 basis point override on indexed annuities, 0.075% override for SPL. Life target, you get 15.15% basis point override. So again, as a thank you for entrusting us with that referral, and you will get this continuously as long as that agent places business. That marketing reimbursement account that I mentioned earlier, for every $100,000 of placed premium for indexed annuity, you will get $100 in that marketing reimbursement account. And for every $100,000 of single premium life, which is business that you would do, for example, with One America, we put $200 in that marketing reimbursement account. And what that is, think of it as a savings account for business expenses. So if you purchase a computer, you purchase leads, anything business related, send us that invoice and we pay up to 50% of that invoice as long as that money is in your marketing reimbursement account. We have strong back office support from case design assistance, forms. We do life and annuity quotes. We have paperless contracting. You can go right on our website and do a Firelight app, which I'm about to get to soon. And more importantly, I think out of all of this is our submission to commission support. And what I mean by that is when you submit an application to us, we scrub that application from top to bottom, make sure nothing is missing, give you a call that day and let you know that we did receive that app, let you know any corrections that are needed, and then we submit that day to the carrier. We follow that app every 3 days. We're looking at that application to make sure that it's moving smoothly and quickly through the new business process all the way to commission. So we track that all the way until you get paid. We know that it's important for you to get paid quickly, which is why we are so aggressive when it comes to our new business. We do have Firelight, which is now accessible through our IMS website. If you have not done Firelight, gosh, it makes it so much easier and quicker for your business to go through. The carriers that are available now are on the left-hand side, and we are continuing to grow those carriers. So it allows you to do an e-app right on our website that goes directly to the carrier. Again, great, efficient, and quick way to get your business in and out as quickly as possible. We have our creative team that will help you with any newsletters, postcards, flyers. If you don't have a logo and you need one or you need revamped, we're able to help you with that as well. Your personal website, if that looks a little old and tired or you don't have one, we can help create and manage that for you, as well as online newsletters and social media consulting with LinkedIn and Facebook. And so we're more than happy to help. We've got a great team over on the creative marketing side, so please give us a call, ask for creative marketing, and see how we're able to help you. Our website has some amazing tools as well. If you're not registered for our website at www.iamsinc.com, I encourage you to get registered. There you're able to pull forms, you're able to do quotes, you're able to look at current annuity news and what's happening currently with the DOL and all the changes there, you know, industry links, you know, our top annuities for fixed or indexed are on there. You're also able to register for any of our training, and it has all of our webinars for the month listed that you can register for, but it also has all of our recorded webinars in a library that you can click on. So please register for our website if you haven't already. If you need help with that, please let me know and I'll be more than happy to assist you. We also have, so not only for just writing business with us, you know, we give all of those you know, previous benefits that I spoke about, but we also have just an amazing top producer summit. We have a long qualification for this. We started December 1st of 2020 and goes all the way through June 30th of 2022. You need 4.5 million points to qualify. And again, that's single premium life, annuity, combination of all your business. And this is an absolutely amazing cruise, just amazing. You're going to Rome, Venice, Croatia, Greece, you and a guest, and it's all expense paid. So we pay for everything. You get balcony concierge level cabins for all of the attendees. This will be just an amazing opportunity for you and your guests. It'll be just so beautiful visiting all of those different countries on the cruise. So if you have questions on that, let me know. Hopefully this gets you excited. You have all the way until June 30th of next year to qualify, and we will be more than happy to help you get qualified for that. And then we also have of course, our Facebook and our LinkedIn. So if you have questions on that, you can go ahead and just follow us on LinkedIn, follow us on Facebook. A lot of great opportunities there. So again, let me know if you have questions or can't find us, and we'll be happy to help you. Right now, I am going to turn this over to Brent DeGroot. He is, again, one of our great resources at One America, and he's going to go over some sales advantages with you with One America. Brent?
Well, thank you, Sandy. I appreciate that, and I'm going to swap here. I think everybody should just see a welcome screen. Would you concur, Sandy, just to make sure that everybody's seeing the right thing?
Can.
Excellent, wonderful. Well, I tell you what, IMES is a great partner with us here at One America, and man, the tools that they have and the benefits that they have for working with you is great. And I will say this, I've been on a couple of Mediterranean cruises, and if you've never been to the Mediterranean and all those places that they're listing there, it's a once in a lifetime experience. So work hard to get there, and again, IMES will certainly help you do so. Yes, as Sandy said, I am Brent DeGroot. I'm the Regional Sales Director here for One America, and I wanted to talk a little bit about what we've got going. I wanted to make sure that you had a good overview of the solutions that we have for long-term care planning. And if you're doing long-term care planning with your clientele, you will understand that there's really two types of protection that are out there. You've got the traditional side, and quite honestly, the 20 years that I've been doing the long-term care world or working in this space, 18 of it was spent on the traditional side. Just recently, I came over to One America just about 2 years ago now. So I understand both sides very well. And, one of the biggest things that we had to overcome, obviously, on the traditional side was the use it or lose it objection. And nothing more frustrating than that, even though, and I will never disparage traditional, because I think there's many client situations out there, and many situations, every client is different. So, but what I will say is when you come up against that use it or lose it scenario, it is very easy to overcome with an asset-based solution, because we've got everything kind of built in. And a slogan that we use here at One America is live, die, or quit. So whether they live and they need long-term care, this type of planning will give them the benefits that they need, the income that they need for those long-term care expenses. If they want to quit, I'm not sure really why you would do that, although last year COVID, impacted some people, and we did see people need to at least take back a portion of their money to have some living expenses while getting through this pandemic. So maybe that's one reason, but there could be other reasons that they needed to quit or get some money out of this plan. It's still their money, so they have access to it. Obviously, there's some surrender charges and that sort of thing that would be applicable, but again, still have access to their money. Or they die and they never need long-term care, that use it or lose it scenario. What we do here is provide then a death benefit for their heirs, so they can create that legacy plans as well with our asset-based solution. So live, die, or quit, they're always going to get something for the premium dollars that they pay for. So we've got two types of asset protection at One America. We've got our life insurance-based solution. We see about 70% of our business here. That's that suite, if you will, is called asset care. So asset care is our life-based asset protection here. On The annuity side, again, very creative naming here, it's called Annuity Care, but that's an annuity-based solution. And I'll get a little bit more into the timeline, if you will, describing this in just a couple slides here. But just know that we have two different types: the life-based, which is asset care; the annuity-based, which is called Annuity Care. So another big objection that we heard really with any long-term care planning out there is when folks say, you know what, I've got enough money, I'm just going to self-insure. And so sometimes that can be a difficult one to overcome. And, you know, I will say, if that's what they're thinking, there's always a better way of doing that. They can still self-insure, but do it in a more efficient manner. And that's exactly what I wanted to talk about here today. So if they're going to the self-fund route or mindset, if you will, look at this well-balanced portfolio. You've got your aggressive funds poised for large growth, obviously comes with some larger downside risk. Moderate funds still poised for growth, but not as much risk as your aggressive. Then you've got your conservative funds, which are, you know, certainly built for or used for asset preservation and protection. Many times that has guarantees built in. And so let's say in a hypothetical here, we had a married couple and one of them needs care. And so where do they go? They don't have a long-term care plan in place. They said, I'm going to self-insure, so they go right to their portfolio. And let's say that first year they take out $125,000 for that needed care. Well, that's all well and good. And this well-balanced portfolio, it's only peeling out a portion. And if that's all they needed of what is 1 year of care, great. But that's typically not the reality of what happens. You know, let's look at, you know, many types of situations, but let's look at dementias or Alzheimer's or Parkinson's, and those we could be talking 8, 10, 12, even 20 years of care need. And how quickly would that wipe out this portfolio? So this is just 1 year of care, but what if they needed a second time or a third year or a fourth year, or again, continuing on? You see how quickly that portfolio gets depleted. And especially the case of spouses. Now you're depleting this whole portfolio that was built for both of their retirement strategies. And if you wipe it out using it for just one spouse, what does that do for the other? Really leaves them impoverished, and that is not the best way to go about this. So there's a better way to self-fund, and let me show you what I mean. We'll look at the same portfolio, exactly the same, and I'm going to peel out just a portion of that portfolio. I'm going to take it out of the conservative funds. That's where it's, you know, typically guarantees are built in, and it's poised for, you know, asset preservation or conservation of principal. And that's what we're going to do here. So I'm just going to peel out a portion of that, and I'm going to create a long-term care plan. By doing so, using our asset care solution, we take a single premium. It doesn't have to be a single premium, but in this particular slide or scenario, I'm going to say it's going to be a single premium here of $125,000. So the same amount as just 1 year of care that they needed in the previous example. We're going to leverage that up in a whole life policy. Again, asset care is our life-based solution. So it's a whole life policy. We leverage that $125,000, make a death benefit out of that. Here in this example, $200,000 death benefit. Well, that's where they're going to draw their long-term care expenditures from. But again, if they don't need it, they pass that death benefit on to their heirs. So again, we can leverage that same amount of money for just 1 year of care in that example on the previous slide, and now give them extra amount of dollars. Now, looking at that more, you know, comprehensive type of care need that was 4, 6, 8, 10 years, 20 years, doesn't really matter. What we like to add here, and it's unique to One America, is that we've got a COB rider, continuation of benefits rider, that will extend the death benefit or really the benefits that are payable for long-term care out to a lifetime income stream that they can never outlive. And that's where the real power comes in. Yes, you can leverage that, give them more benefit for the premium dollars that they give, but when you add in that COB rider and built it in for that lifetime, so that both policy owners here are using their money first, that death benefit first. But once that death benefit is exhausted, with the COB rider, we can create an avenue that creates an income stream specifically for long-term care that neither one of them can outlive. So very powerful here. And again, that lifetime structure is unique to One America. So here's our whole suite of solutions, if you will, asset care, again, our whole life side. And we can fund this a number of different ways. Single premium, we see a lot of that. Our single premium with return of premium. So if they didn't want those surrender charges to always have access to that money at any point, that return of premium would do so. Or on their death, it will return all of that premium as well. So we've got that option as well. We've got our annuity funded whole life. Now, I like to call this our qualified option, and I'll get more into that here in just a little bit. But we're starting to see a lot of this, the last option out there, which is recurring premiums. Not everybody has, you know, an amount of money that they can just one pay and be done with it. So some people need to plan on a recurring basis. And so we've got options for recurring premiums as well. So we're starting to see a fair amount of recurring premiums come in, getting closer to that 50-50 split, single premium and recurring premiums. But I just wanted to at least outline all of the funding options that are out there. And under each one of those options, you can see that there's a lot of ways to create those types of premiums, whether it's cash, 1035 exchange from, you know, other old non-needed life insurance, you know, maybe RMDs. There's a number of ways that you can really tackle these premiums that we would create or just reposition that portfolio. On the annuity care side, I'm going to focus more on annuity care here in a little bit, but we've got 3 solutions there. I'm going to leave that for now. We'll come back to that in just a little bit. So we're going to continue on with asset care, which is our whole life-based solution. So with that, I like to simplify this as much as I can. And why do I say that? Well, first and foremost, here at One America, we've got a lot of options. And what comes with a lot of options is a lot of flexibility, and really a great way to tailor design any long-term care plan for whatever the client's situation is, whatever their needs may be. So it's a blessing in that regard that we've got all these options, all these ways to create these plans. Now, there's a downside to that, and that downside, or the curse, blessing and a curse, the curse is we have all these options and people can get lost in some of those. So I like to simplify this as much as I can. And I basically say it this way: our policies, our plans are a base policy plus a rider. Simple as that. So the base policy, again, is either a life or an annuity. And the great thing about that is it pays tax advantage for long-term care. And then you've got the rider, or the continuation of benefits rider. That's what COB stands for. And that rider will either double the base policy, that death benefit that it was created, or we can extend it for that lifetime income stream that nobody could outlive. They'll have that as long as they are living. So hopefully that was simple enough. So that's kind of our timeline, if we call it, and you can kind of see why. But now let's look at a little bit of the specifics here as I'm going through kind of an overview. So the base policy issue age is 35 to age 80. I like to talk about that. Age 80 especially, and that's why I've highlighted it. If you look at other long-term care planning solutions or options, you're not going to find that they go up to age 80. And COVID even impacted that even more. Now, we never reduced anything with COVID underwriting as far as the ages that we went up to. I know many carriers drop their ages that they would even offer coverage to. We never did. We still have a limitation, but it's only single pay over age 70. That is a temporary thing. It will change, but I just really wanted to focus on those ages of 35 to 80. To still be able to plan for somebody at age 80 is a very good thing, especially, if they failed to plan, they forgot, whatever, they finally woke up to, hey, I'm not going to bury my head in the sand, whatever their situation was. To have that ability to still plan at age 80 is a big deal. We can create either single or joint plans, and that differentiates us from our competition as well. A joint plan built with unlimited benefits, wow, that is total peace of mind. I'm going to get into that here in just a little bit as well. But just know, we can do it on a single basis, or we can have them both be on the plan, both sharing that death benefit and both receiving the benefits from the rider, if we add that as well. Again, sources to fund the premiums here: cash, qualified money, 1035 exchanges from a life or annuity. We've got single premiums, 5 pay, 10 pay, 20 pay to age 95. That's really our annual option, if you will. But if they reach age 95, it's a paid up policy. So no more premiums after that. They're all guaranteed premiums. As we're seeing in the traditional world today, there's been a lot, today and the past, 7-8 years now, there's been a lot of rate increases that have had to be passed on to those consumers for missed assumptions. But this is based on a life insurance contract, so therefore it's guaranteed premiums. They cannot raise. There will never be a call from your client to say, hey, I just got a rate increase notice. We didn't, I thought that this was set and forget. So just know, guaranteed premiums, guaranteed cash value, death benefits, all these guarantees are built into these plans. So you'll never have to worry about taking those follow-up phone calls, if you will. We've got inflation options that you can add to both the base and the rider. And then we've got acceleration options, and I'm going to go into that in the next couple slides here and talk about exactly what that means. So then we get to the rider side. You're going to see much of that same information on the base, so I don't think we need to belabor that point, but it really applies to both base and rider on our timeline. So I told you I'd talk about this acceleration piece and what that means. I don't like this in the way that it talks about these months that are up there. Really, it's the acceleration, taking that death benefit and how quickly do we want to accelerate that? Do we want to take that death benefit and accelerate by 2%, 3%, or 4% for singles only? Couples can have 2 and 3, singles can have 2, 3, and 4, but only singles can have the 4% option. Now, acceleration, what does that really mean? So we're going to accelerate that. In the case of a 2% option, it's over a 50-month period. So taking that death benefit and creating the long-term care benefits by a 2% margin. So that will extend that for a 50-month period. That means it's going to be a lower amount of long-term care monthly amount for expenditures because we're stretching that base policy over 50 months, When we reduce it to 3%, and this is where we run most of our joint situations is on the 3% option, we reduce that 50 months down to 33 months. So they're going to, use that death benefit over a period of 33 months. That's what we call the 3% acceleration. 4% is over a 25 month. So the smaller you get in the number of months or larger you get in the acceleration, the more long-term care benefits will be there. Then when you add the COB rider, on the 2% acceleration, you can have another 50 months or the lifetime rider, like I said. 3%, 33 months or lifetime rider, 4%, another 25 months or the lifetime rider. So let me give you just a quick example of how that works so you maybe understand or wrap this idea up, if you will. So here's a life insurance policy. It's a $200,000 death benefit. we use the 3% acceleration. So we're going to accelerate that over a period of 33 months. So that 200,000 accelerated over 33 months gives each person on this policy, whether it's a joint couple or joint situation or single, because it's 3% acceleration, it would give each person $6,000 per month in long-term care expenditures. So it's a reimbursement contract, so up to $6,000 per person per month for 33 months. Now, when we add that COB rider, and especially if we added the unlimited, what happens here is once that death benefit, that base policy is exhausted, they get into the continuation of benefits piece. And what that does is it continues that same $6,000 per person per month for their life. They can never outlive those benefits. So big reason that we like unlimited benefits and joint policies gives two individuals the same death benefit, and then you add that unlimited benefit rider, and it doesn't matter how long either person has a care need, there's going to be an unlimited income stream for LTC expenditures. Now, I'm going to apologize up front. This is a very busy slide here, but I think it does a great job of outlining this particular, what I call the qualified option with us. Did you know that you can use qualified funds to create a long-term care plan? Many advisors and insurance professionals had no idea. Well, we've had this actually out since '92, so we've been doing this a long time. But I want to explain how this works. Like I said, there's a lot on this slide, and I'm going to try and go through each part so I hit each piece. But I really like this solution because if you look at the portfolios that are growing today, the average American is growing most of their wealth or their retirement plan in a pre-taxed vessel, whether that's a 401k, a 403b, an IRA, a personal IRA of their own. Whatever the case may be, usually they're doing it on a pre-tax basis, so thus qualified fund source. Well, I want to show you this example because in this particular example, we had a joint couple, Bill and Mary, both age 60. And what happened, from this particular situation, Bill had an old IRA, and I can even think of it this way. Think of it as an old 401k. Maybe you've worked for, a company in the past that offered a 401k or a nonprofit that offered a 403b, or yourself and just created this IRA out there. And so say you moved employers and you just kind of left that 401k where it was at. Well, that's kind of the situation that Bill found himself in here. So he has this old IRA of $250,000, and he decides, we haven't done any planning for long-term care. Let's just I can use qualified assets. Well, great. Let's just use this old IRA that I've got over here of $250,000. Now, I think this is a little extreme example, unless he's, worth 4, 5, 6 billion. I don't know. But, it's an old IRA, and he wanted to just transfer that $250,000 into our qualified solution. So here's what happens. Basically, we call this the annuity funded whole life. So it's still under asset care. It's a life-based solution. It has annuity in the name only because here at One America, it's a qualified annuity that we put the transferring funds in. So we'll take a trustee to trustee transfer. So of that asset, so no, tax implications to the clients at all on that transfer. Put it into our qualified annuity, and we're automatically going to give it a 20% bonus. So in this particular case, $250,000 came over. We give it the 20% bump. Now we've got $300,000 to work with. I like this hourglass here on the left because I think this gives you a good visualization of how this works. So let me explain how it works and then think about how an hourglass works. When you flip it over, right, the sands drop from the top down to the bottom. So what we're doing when we take that transfer, we put it into our qualified annuity here at One America. That's the top of the hourglass. Now, we're not going to drain it sand by sand. We're going to drain it in a 10-year period. So we split this out over 10 equal amounts. So that $300,000 becomes a $30,000 distribution to fund the life insurance policy, which is the bottom of the hourglass here in our example, and the COB rider. So again, it's not single drops of sand, it is 10-year chunks. So that's why the $30,000 distribution happens. Now, we said this is qualified funds, right? IRS is never going to forgive getting their money. There's still going to be a taxable distribution. So that distribution over those 10 years will create an LTC 1099. So just know that up front. But part of the reason we give the 20% bonus is really to help with some of that taxation. And it just helps for better long-term care planning or retirement planning, overall tax planning. So we spread that out into 10 equal 30,000 distributions to fund the life insurance policy. Here's how it was split out in this particular situation. So 15,000 or just over 15,000 goes to the base policy. That creates nearly a $300,000 death benefit. We chose a 3% acceleration option. And so that acceleration option then created nearly $9,000 of LTC benefits per person. We also used the other side of that 30,000, so a little over 14,000 here, to fund the COB, unlimited rider. So once they exhaust that nearly $300,000 in their death benefit, if they do, that's when the unlimited rider would kick in, that continuation of benefits rider. That continues that nearly $9,000 per person per month of LTC expenditures or income needed for any of those expenditures. Couple things I want to mention here. Let's say your client reaches the age of majority and needs to start taking RMDs. Now, let's say they don't need their RMDs for income. There's many clients out there that are like that. These distributions from the annuity to fund the whole life plan here will count towards RMD distributions. So great little nugget there for you. Another nugget that I want to impart here is that let's say we have and before I touch on that, I should talk about the age bracket that this is available for, 59.5 up to age 80. So because qualified funds, this distribution 59.5. However, understand this. If we have an inherited IRA, now we can use this same solution. It complies with the Secure Act changes that happened a couple of years ago. And using their drain in 10 rule, this fits perfectly for those under age 59.5, and we don't have that, pre-tax penalty for them since it was an inherited IRA. So just know the great wealth transfer that's out there, the golden age, the boomers, they're passing wealth on to these Gen Xers, these millennials, and now all of a sudden they may inherit some sort of qualified source or an IRA or something like that. So this is a great way to plan for long-term care expenditures, satisfying the Secure Act and using this solution. Again, I'll call it the qualified solution. All right, so what are the advantages of using asset-based over traditional? Again, the live, quit, and die, which I talked about. We've got the guaranteed premiums, cash value growth, death benefit, cash surrender value. These are all guaranteed. Never will change. They know right from day one exactly what they've got available to them. Joint coverage and second to die. Again, if you can put a plan in place where you've got both spouses sharing one pool. And this is unique to One America again. We're the only ones that have a joint policy like this. It's a joint second to die structure. But when you can put that coupled with our lifetime unlimited protection, you have total peace of mind with your clients and, quite honestly, with yourself. Because now you know that when they have a long-term care claim, no matter how long it is, they're not going to come back and start invading maybe the assets under management that you have. Again, total peace of mind for your clients, most important. But remember, that's total peace of mind for you as well. And to drive this fact home even further, I love this little example here, and I wanted to hit on that as well. So, little dot plot matrix here. Each one of these blue dots on here represents a long-term care claim. I've removed the axis and radius, so it doesn't really matter here. But now some people, whether it's advisor, insurance professional, even the client themselves, fall into what I call the average trap. And please don't fall victim to falling into that average trap. And why do I say that? Because if I add a line here and show you what the average is, 9 of those blue dots hit on the average. So if you plan for that, great. You know, you hit it exactly perfect, wonderful, said and done. Now those below the line, if you plan for the average, yes, they would have worked, right? Because they're not above the line. But look at all those above the line. Nobody knows what the future holds. Nobody understands how long they may need care. And especially those that have health history with dementias or Alzheimer's and that sort of thing. Why do I believe that lifetime matters, that unlimited benefits that we offer matters? Is really this. We get rid of the line. Every single one of those blue dots now has a lifetime income stream that those clients cannot live. I think that's terribly powerful. Hopefully you found it powerful as well. All right, now I want to move on to the annuity-based LTC here. Same portfolio, same sort of thing. We're just going to peel away a part of those conservative assets or a portion of their portfolio and create an annuity, which gives we could leverage that amount that they gave us, leverage that for the LTC benefits here, and then again, we can create that lifetime income stream. So when to use our annuity care solutions? If you're working with clients that are, 70 and above, I want to stop here as well because you see it goes up to 85. So where our asset care, our whole life solution stopped at 80, on our annuity care side, we can actually go up to age 85. And a little known fact, if we're going base only coverage, no COB, continuation of benefits rider on annuity care, we can actually go up to age 87. So for those that failed to plan, what a great solution. Now, let's say your clients, if they're, not only in that age group or whatever, let's say they have some non-qualified annuities sitting out there with significant gains. And they know when they take that out, it's LIPO, right? Last in, first out. So they're going to be taxed on any of that income first when they're taking that out. Well, what if we gave you a way to get rid of all of those gains? And I'm going to show you that here in just a moment. And then if those clients have health concerns, that's another reason to look at our annuity care solutions. Like I said, we're about a 70-30 split between asset care and annuity care. So health concerns here, much easier underwriting, if you will. We're still doing both. Oh my gosh, I'm drawing a blank. We're still doing both sides of underwriting here. And so we'll work on the health side and the life side. So just understand that we're doing both sides. But with the annuity care suite, we're really only asking 5 underwriting questions. and they're essentially knockouts. Then we do an MIB and a script check, and it's accept or reject. So that's why we look to Annuity Care for those with health concerns. So if you know that they've got a significant amount of health concerns up front, sometimes it's better to just look straight to our Annuity Care suite. So one of the options and why we look at Annuity Care so much is utilizing the Pension Protection Act. The Pension Protection Act did a number of things, but what it did for us in the long-term care space is allowed for a non-qualified annuity to be 1035 exchanged for long-term care purposes. So what we're going to do here is we'll take the existing non-qualified annuity, both the cost basis and the gain, we'll 1035 that into our Annuity Care solution, which is a PPA eligible, HIPAA compliant annuity that then says any distributions from that annuity will be income tax free if used for long-term care. So now we get rid of all of that gain. They're not taxed on that piece if they're using it for long-term care expenses. So what a great little solution, or use the PPA to get rid of a lot of taxable gain out there. And then obviously we can add that optional continuation of benefits rider as well. Like I said, I like to simplify things, so we're back here to our timeline. Annuity Care simplified, again, base policy, single or joint annuity goes straight into the PPA eligible annuity with us, 1035 exchange it, and then you can add the COB rider as well. So there's three different solutions. The right side of our graph here, if you will, is all our Annuity Care solutions. We've got Annuity Care I, Annuity Care II, and indexed annuity care. You can see there's a variety of ways that we can fund this. It doesn't have to be just a 1035. You can fund these with cash, qualified money, existing non-qualified, a lot of ways that we can fund these options. Now, I'm going to give you one solution in the slides here, and we're going to be talking about Annuity Care II, because it is a straight leverage play. And this is the only annuity out in the Annuity Care suite that actually builds in the COB rider. So with this particular annuity, there's going to be a telephone interview as well in the underwriting process. So if you've got anybody with any kind of cognitive disabilities and that sort of thing, obviously they're going to have to go through a telephone interview. That probably is, Annuity Care II is not the option here. We also drop the age to age 80 again on Annuity Care II. So just wanted to make you aware of that. But everything else, pretty straightforward. This is straight leverage play. And let me give you an example. So we had a fixed annuity here of $100,000. They 1035 that over to us. And basically what we're going to do from that $100,000 that they gave us, we're going to leverage that up, and we're going to also pay for the continuation of benefits. So we leverage it in the fact of adding another $150,000 to that $100,000 annuity for those continuation of benefits. That is drawn from monthly charges out of that original annuity. So what does that create? A total pool of leveraged amount up to $250,000. So from 100 to 250. So 2.5 times leverage, straight leverage play here on Annuity Care II. Now, if I back up and talk about Annuity Care, there's a couple of ways that I like to look at these. If you've got a joint situation, I think Annuity Care is probably a really good option, because it also has a COB kind of maximizer is what we call that. And it can actually double the COB payouts when they reach the COB portion, the rider portion of that policy. So I like to look at that. Also like to look at it for the the elimination period difference. So on Annuity Care II and Index Annuity Care, it's a 60-day EP. With our Annuity Care, it's just a 7-day elimination period. So a couple reasons that I like to look at Annuity Care there. But then I want to go into our index. Now, we created this indexed Annuity Care really for one main reason. There's a lot of clients out there that see the market, doing as well as it has, the longest bull run we've ever had in history, and they want to participate in some of that. So our indexing strategy here is based on the S&P 500. We give them 5 different choices. I'm not going to get into those today because, again, I want to keep this more of an overview. And then we can create that fixed indexed annuity. So it's a fixed annuity, but it has an indexing component as well. So there is growth with the fixed annuity, very nominal. These are created for long-term care, not for your income needs, with maybe some other annuities that happen to be out there. But then we can add, or the piece of the indexing that's in there is the 5 different strategies based on the S&P 500. We can add the continuation of benefits rider here. This is another one where it gives you a couple options. We can either double it, triple the original amount, or create that lifetime income stream again. So again, I don't want you to have to know each and every piece here. Just know that the folks at IMES are there to help you. They do a great job with us. They can help with those situations. So any questions there on positioning or whatever, work with your partners there at IMES. So advantages in taxation, the advantages of buying down the cost of catastrophic protection. Obviously, there's guaranteed premiums. Assets are retained if they never need care and passed on. Rider provides that additional LTC coverage if the base annuity is fully depleted. Obviously, options for those with health problems. That's good for our annuity care solutions. Taxations, tax-deferred interest on accumulation. LTC benefits from the base are tax-free when funded with a non-qualified PPA premium. And then any LTC benefits are going to be tax-free as well because this is a qualified PPA eligible annuity. So really 3 easy questions to get started. And IMES will ask you this with any of your solutions. I'm actually going to add a 4th, but first and foremost, how do they want to fund the plan? So if you call your partner there at IMES and say, look, I've got a client situation here and, I want to build show them some options for long-term care planning. They're going to ask you a couple quick questions. How do they want to fund the plan? That's a key component here. What is the age of the clients? That will drive maybe where this conversation goes as well. What is their general health? So really simply 3 easy questions that they're probably going to ask. I'm going to add a 4th, what state they're in, because that's important as well. So just be aware of that, that there's some state differences, especially in California. Actually, California right now is the only outlier. Every other state is the same solution suite, but unfortunately, we're still waiting for approvals. So just know that out there. So we'll need to know what state to run the quote in as well. All right, we underwrite to approve. There's a lot of situations that you couldn't get covered on a traditional plan out there, or even some of our competitors in the asset-based space. And because we're underwriting for both morbidity and mortality, I knew it'd come to me. Because we're underwriting for both of them, we have ways to actually table rate. We can go all the way up to table 8 for these types of solutions. And even up to table 4 is still going to be our preferred rates. So just know that you've got some areas that really you can highlight as far as underwriting are concerned. And we can table rate because we're doing both sides of the underwriting, mortality and morbidity. Here's your height weight guidelines, and quite honestly, I like to look at this as, look, Indianapolis, One America, we're a meat and potato company right in the Midwest. If you look at this height and weight chart and look at some of the maximum weight ranges, you can see that it's pretty much a Midwest company, and we'll take a lot of situations. So I'll leave it at that. So what sets us apart? That we've got both the life and annuity-based solutions. We've got joint or single life. And again, that joint policy structure, that second to die structure, really is great for clientele, for your spouse situations out there. And, if we can couple both of their money together, many times we get more benefits than some of our competitors where they have to create for the same amount of money, but be creating separate policies for spouses. So again, joint or single life with One America, a variety of funding options, our optional lifetime benefits, really powerful on either single or joint, but that joint situation, I just think it's total peace of mind. Claims concierge, I haven't mentioned this, but basically this is a great little service that we hear nothing but praise from, families when the rubber meets the road. When that claim time hits, we have an 800 number that they'll call into. It's actually trained nurses on the end of the phone in Indianapolis, and they work with the clientele to make sure that they have all the pieces that they need. They understand the policy, how it works, really trying to provide the best care possible. And one of the reasons we call it a concierge service is that from start to finish, they're going to have one claim concierge available at the end of that telephone line. So there's no longer having to call in and re-explaining the situation, that sort of thing. So again, we hear a lot of great client testimonials about our claims concierge service. And that's really the most important thing, because that's where those claim time arises. That is a very tumultuous time for any family. And so they really help putting that family at ease. And again, I mentioned those reasonable underwriting guidelines. Because we're getting close to time here, I want to give you some quick links. AssetBasedLTC.com. If you're unlicensed, not contracted with us, feel free to go there. You can find actually our calculator on there. You can find some information about our products and that sort of thing. If you are licensed with us, you can take it a step further. Check on your cases, all of that. You go to ols.oneamerica.com. And then this is a piece that I've worked with a number of producers here at IMES. They have a great way to build maybe your website. If yours is a little outdated, help you update that. But I've worked to get them situated with our One America marketing store to put more content on their website and to build something that I really like, which is a great conversation starter, or just really good information to kind of start the conversation around long-term care planning, because I think sometimes that's where people get hung up. They're not experts. Their client may have to ask them first before they'll even, talk to them about long-term care planning. But if you want to start that conversation proactively, here's a great website for you to just hand out. Give some very good educational information around long-term care issues and costs. And it's www.experiencecaresolutions.com. I won't bore you with going through each and every slide. When you come to the very end, the last step, there's a last step here. It's a kind of a call to action. So ready to take the next step, reach out to the financial professional who, sent you this information. Or I can go one further. By getting you registered on OMES, the One America marketing store, we can actually customize this for you so that all of your information will show up, not mine. So we can make this a customizable website as well. You can put that link directly onto that website that IMES helps you with. Like I said, I've done that with a number of producers that IMES has helped bolster their website as well. So wanted to make sure you're aware of that. If you have any questions about doing that, certainly, again, reach out to your IMES partner. They will get the information needed, and we will get you set up on that website, and we can customize a lot of materials actually on there, not just this interactive website. So with that, that is going to wrap it up. I will say thank you. I know we're right up against time here. And Sandy, I'll turn it back over to you. You may be on mute, Sandy.
Sorry about that. So I did want to launch just a poll question on whether or not you'd like to get contracted with One America. Let's just see if we have any questions that we can try to answer as well. So let's see here. Can you, it says here, one moment. Can you fund with a beneficiary IRA?
Yes, you can. Simple short answer, yes, you can.
Okay. Are there any fees to this product?
There are no fees. When I said our Annuity Care II, there's some internal fees that pay for the COB rider in and of itself, but that would be really the only solution in our suite that would have internal fees. Other than that, there are no fees in our solutions.
Okay. I think those are all the questions. So everyone who has registered for this webinar, we will send you out a recorded link to that. Everyone who has stated that they wanted to get contracted, if you're not already contracted with us, we'll send you out the contracting paperwork. Just so greatly appreciate, again, everyone taking their time for what we consider a really important product to put in your tool belt. So Brent, thank you so much for your time. And everyone, again, give us a call if you have any questions. Everyone have a great and wonderful week, and we'll hopefully talk soon. Thank you. Bye-bye.
Thank you all.